This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Everyone, welcome to Covered Calls, my podcast. I'm Kevin Simpson, and for those of you who are tuning in for the first time, I'm the Chief Investment Officer of Capital Wealth Planning based in Naples, Florida. My goal here is to engage with some of the best and brightest minds on Wall Street. And today I'm extremely excited to have with us our guest, Joe Terranova, Chief Market Strategist for VRTS Investment Partners. Hey, before we get started, Joe, I'm a huge fan. Started watching you on Fast Money and now up and down the network all day long. I mean, I just love watching you on CNBC. On a very personal note, I have been getting some exposure on the channel as well, a little bit more recently. And I'd like to say to our viewers and let them know what a great friend and mentor you've been. Anytime I have a question, coaching, counseling, your advice has been amazing. You've been a great sounding board. Even one of the first times I was on, you took a good half hour, kind of teeing me up beforehand to prep me. So I am grateful, and I just want to publicly thank you for that.
Well, Kevin, that's very much appreciated, and I'm excited to join you here today. You are doing a fantastic job in delivering quality, actionable content on the network. The journey of your progression has been very enjoyable to watch. Keep doing what you're doing, because you're helping the viewers, you're guiding them to the right places when we think about portfolio allocations.
Well, thank you for that. And in this podcast, our primary viewership are financial advisors, and being able to communicate and help our financial advisors communicate to clients is so important, and probably more today than ever before, at least when markets are in turmoil and volatility. And I think, the more things change, the more they stay the same. And with that, when you got into the business, and we've had Mark Fisher on the podcast before, I mean, certainly one of the top, if not the most notable commodity traders on the planet. And you think about learning from some of the best, how did that experience prepare you for where we are today?
Well, I think it specifically prepared me for the environment of now, because the primary focus in what Mark and I did was to always elevate the importance of risk. Risk was, without question, the most important word in our financial vocabulary. It was never about how much can you make. It was about how much exactly can you lose. And right now, to your point, Kevin, what I'm doing for VRTS Investment Partners is every day. And the remote environment has actually been a very beneficial one for myself and for VRTS, because I'm able in a very unique way to reach in that communication capacity, which with hundreds of advisors on a daily basis, where previously, as you know, it was a flight to somewhere in the United States and a couple of nights in a hotel to maybe speak to 50 advisors. So I'm able to reach far more advisors. But in this environment, I'm kind of emphasizing risk and thinking about the acceptance of risk and prioritizing and understanding that you want to make sure your speculative and leverage levels are properly aligned with what you and I know to be a very challenging environment.
It's funny, people only care about risk when markets are down. Where was everybody in 2017, 19, 21, complaining that we had too good a return in some of the indices?
I try and simplistically explain it to people in the analogy of football. It's unrealistic to think that your opponent is never going to move the ball into your field territory, right? They're at some point, they're going to cross that 50-yard line and they're going to be sitting in your territory. And guess what? They're going to score. Well, okay, let's try and position ourselves in a way where we're giving up field goals and we're scoring touchdowns, right? And I think that type of mentality is the same one that you want to apply to this environment, where it's not so much that you're risk averse, but you're prioritizing risk mitigation. That's so incredibly optimal for a portfolio strategy.
Well, Joe, you gave us the sports analogy, so I'm gonna take us into your, going back again in time when you worked on the floor, when you worked in the pits. Not only do you have to be a professional trader, but to the extent that there could be some physicality down there, you had to be almost a professional athlete sometimes. We had Pete Najarian on a few weeks ago, and he had some pretty funny stories to talk about. But anything from your days on the floor that come to mind to share with the financial advisors today?
Well, I think what you learned is you learned about emotion. And it's interesting, Kevin. I think that the study of markets from a historical perspective are nothing more than cycles repeating themselves in terms of the way people panic and react, and human emotion prices assets, because human emotion is what prices assets in the capital markets. So I observed that in a very physical environment, which was a trading pit, and noticing as volatility was intense or elevated, well, emotions were intense or elevated. And a lot of times you saw people lose their cool. And the people that kind of lost their cool, they're the ones that at the end of the day, they had that downtrodden face. And you knew that unfortunately they didn't have their best day. And I think the same thing could be said for long-term investors and for advisors when they're thinking about communicating with their clients in this environment. It's about managing your emotions, right? It's never really being too emotionally high and never being too emotionally low. Extreme optimism and extreme pessimism, those are two human conditions that I don't think apply themselves properly in terms of portfolio construction. You have to be very emotionally balanced. And I try and do that. And I learned that lesson many years ago working with Mark Fisher and in the trading pits. And I think I do that on CNBC. I try and do that on the halftime show, just kind of be not too high, not too low, just be even keeled, emotionally balanced. That works for me.
And you do, and you come across as a very calm voice to the viewers as well. And there are TV personalities sometimes that don't, that become emotional. And to your point, whether that's on the high side or the low side, I always talk about trying to separate the emotions from the metrics, and everything we do is math-based, rules-based. I can still get emotional, but it doesn't change how we invest for the long term. So in covered call writing, just an example, there could be instances in which I get a stock called away that I want to own. I mean, I might be throwing things across the room, angry that we didn't capture all of the potential upside. But at the end of the day, it's that mathematical equation that gives us more probabilities of success over time. And it's okay to be emotional, but you can't let that affect how you make decisions, because it's never different this time. You said it a second ago, like it's just watching the emotions and the history repeating itself. And after 30 years, every one of these pullbacks may be caused by a different catalyst, but the result is always the same. You know what to do. And Joe, you know what to do because you've done it before.
Yeah. And I think having a rules-based strategy is so important. I mean, if you think about the intuitive investment decision process, right? What is it exactly that's the foundation for that? You're exposing yourself to the emotional input at that point. You're just intuitively looking at the screen and kind of having a feel for things. Well, the emotion of how you just might have woken up on what side of the bed that day is going to directly impact your investment process. So I'm a big believer that a rules-based process is the right process, because Kevin, to your point, the rules-based process is going to supersede whatever intuitive personal perspective or decision you might want to make.
I agree. And I'd like to jump into your index right now, because everyone knows my process, and we're here to hear about the Terranova US Quality Momentum Index, because again, thinking about an approach to investing that is rules-based, that's the most important thing, because as financial advisors utilize our products, they need to know where to position us. So talk to us about the index. How did you put it together? What's the makeup? Let's see how we can introduce this to our financial advisor viewers.
So sitting on the set of CNBC and Englewood Cliffs for the better part of, I would say, 2014, 2015, and 2016, we would have a lot of guests that would join us on the desk, so to speak.
Yep.
And what they would all do is they would come and they would present some form of a thesis or supportive reasoning as to why a particular stock should be considered for purchase by the viewership. And Kevin, in every instance, I kind of listened to them and I looked at them, and what they were usually doing was just basically studying momentum. Basically just studying a chart and saying, well, the stock has gone up a lot, and here are the reasons, the fundamental reasons why we think we could go up more. And I grew concerned about that because I thought the single factor of momentum would do what? It would expose owners to too much risk in an environment where we were reassessing either the monetary, the economic climate, therefore we were repricing risk assets lower. And in fact, I wanted to improve upon a single factor of momentum. A single factor of momentum, it's nothing more than studying a chart. So what I said was, okay, let me begin the journey. Let me begin the process of adding upon that another factor. What do I want to look at? I want to look at fundamentals. I want to look at fundamentals from the perspective of quality. People talk about growth all the time. Okay, growth is great. There's two ways you could look at growth: hyper growth or quality growth. I want quality growth. Well, I want the fundamental factor of quality in a proprietary nature to be combined with momentum itself. And what I did was I introduced a criteria that looked at return on equity, debt to equity, and annualized revenue growth over the prior 3 years, collectively scored that criteria and married it to the factor of momentum and created the Terranova US Quality Momentum Index that studies 500 of the largest companies in the US and then introduces a momentum factor, screens the momentum factor to reduce that number to 250 names, and then finally narrows it down to a list of 125 names that would be owned in the index based on quality. It's equally weighted. It has a reconstitution and rebalance on a quarterly basis. And it was introduced in August of 2020. And subsequent of that, in November of 2020, I'm very blessed that Virtus Investment Partners introduced a product, a publicly traded product, an ETF with the ticker symbol JOET that tracks the Terranova US Quality Momentum Index.
Joe, where did they come up with that ticker symbol?
So something that, and I'll share this with you, Kevin. It's something that was important to me. I wanted to personalize it because I wanted people to understand it was a reflection of the investment methodology that was curated 25 years ago when I was working with Mark Fisher, that was focusing on understanding risk, right? Momentum, single factor, too much risk exposure. Let's improve upon that by introducing quality. So I wanted people to know that it was an absolute reflection on the investment methodology that I had studied and the investment methodology that I've been implementing for the last 20 years.
And you said you were coming up with this in 14, 15, 16, 17. So you had, and maybe even 2018, I'll throw that in as well. So you had some repricing in 15, you had some repricing in 18. So you're able to really look at this in an applicable market as opposed to 19, 20, 21, where everything's going straight up. And momentum sometimes gets confused with memes and other things that really are going higher without the quality component. So I think that's the special secret sauce.
Yes. So in 18 and 19, it was a true quote unquote stress test. And that's when I just had extreme comfort with the strategy, knowing that it would be introduced and it would be beneficial. It would be additive to an advisor that was using it for their his or her clients, thinking about long-term investing and wanting exposure to really what's more of a large cap growth strategy than anything else. But it was in 18 and 19 that I knew I was really confident that it could be additive.
Sounds like a good compliment to Divo, D-I-V-O. There's a shameless plug. So we're equity income. We stay in our lane. And I love the concept of momentum, because stocks that, and this is something I say all the time, stocks that are making new highs for the right reasons tend to go higher. And if I was to simplify your thesis, and I know there's a lot more that goes into it, but I mean, that's a backbone of investing in companies that are trending higher because they're trending higher for the right reason, and not speculation or an internet chat board, a Yahoo chat board. Yes, I'm going back circa 1999, 2000, or whatever, we were modernizing over the past 2 years where there's so much hype and things like that. So I'm excited about the strategy, and I think Virtus made a great decision to partner with you.
I appreciate that, Kevin. What's your favorite sport to play?
I sit and look at the stock market all day. So playing sports is a far cry from my viewership of sports. I'm an Eagles fan and a Philadelphia Phillies fan.
Okay. So if you have a quarterback who has thrown the ball 10 times and only completed 2 passes, the likelihood that the coach on the next 5 plays is going to call a pass is relatively low. Why? Because the quarterback has no confidence. He's only completed 2 out of 10 passes. If you have a quarterback who all of a sudden now completes 5 passes in a row, well, you're probably going to continue to have him throw the ball because he has confidence. And that's what momentum is. From the perspective of observing the market, momentum is exactly identifying for you where confidence can be found within the market. That's what it's a reflection of. And I think that anytime someone is investing with confidence, someone is in their professional career having confidence be the catalyst to carry them forward with momentum, I think that you're going to find yourself in a successful situation. Confidence is what you want to be displayed professionally, personally, and from an investment perspective.
Well, you certainly do that every day on TV, even when the market might be down 5 or 6 percentage points in a week. Not that we've seen that happen recently, but cool heads prevail. The question I have about the strategy, if you're rebalancing on a quarterly basis, does the underperformance over 1 quarter have the ability to jettison a stock out of the strategy, or are you looking for multiple quarters before you'll remove a stock? We all spend so much time talking about how we buy stocks. I love to talk about how we sell them.
I love that conversation. And I could tell you that there was a time that Peloton was in the index, and Peloton and PayPal, these names came out of the index rather quickly in 2021. The reasoning for that, to your point, is we're observing on a quarterly basis. And if there is a precipitous decline in a quarterly basis, well, very quickly, you've lost that momentum factor consideration, and therefore we can move on it quickly. So I like the fact, and it's one of the reasons that I introduced it, that we've got the quarterly rebalance and constitution, because it does not allow for sitting longer than we're comfortable with equities that are experiencing precipitous declines.
Precipitous decline seems like a really polite reference when you're talking about Peloton and PayPal, at least in their recent performance. I can speak on this on a personal note because you and I were texting back and forth, but I was shocked to see this today. I was watching CNBC, and they said that Netflix was down almost 70% on the year, which kind of blew my mind, because I think maybe I'm spending so much time watching Stranger Things right now that I can't believe that the stock wouldn't be at an all-time high. And certainly there's no correlation between my viewership of Stranger Things and share prices. But there was a time that you were very publicly, touting Netflix, and even to me privately. I watched the stock go up substantially. Of course, in our portfolio, we only buy dividend paying stocks, so I couldn't take advantage of your excellent recommendation. But it wasn't that long afterwards where you were not only not a fan of Netflix, but you were a seller of Netflix. And this was a long time. Again, I don't follow the stock, so I can't speak on exactly when it was, but I bet it was like 8 months ago. It was certainly the 2021 when the thing was really very, very popular. I mean, it may have pulled back a little bit, but what was the chink in the armor there that you saw before anyone else? Because that was a perfect buy and a perfect sell.
Okay, so first of all, you have a fantastic memory. I wish the producers at CNBC had your memory, because a lot of times, and I keep track of equity names personally now that I liquidate. I know that personally, I liquidated DocuSign at extremely higher levels than it is right now, but specifically towards Netflix. What I had noticed, and I study momentum, was that in the fall, after a series of sideways price action, Netflix had finally begun to gather positive momentum towards the upside. And you began to see the range expansion concurrent with that and the volume increase. So I initiated a position. And then in November of 2021, very quickly, what you saw was a reversal in price correlating with range expansion again. So on the way in, you had the range expansion, and on the way out, you had the range expansion. In addition to that, you had the extreme volume. And you can't ignore when momentum is deflating from a stock if you were going to place an emphasis on momentum as it was acting as a catalyst to propel the stock higher. So very quickly, I recognized that. And candidly, I got out at Netflix at very, very good levels, far higher than certainly where it is today. And what did it do? It took me back to the genesis of my career on Wall Street, where we worried about how much can you lose. And I ended up doing well in the stock. And if I would have sat with the stock for multiple quarters and given it the benefit of the doubt and spoken about the fundamentals that might take the stock higher, well, I would have really exposed myself to a very significant loss.
How important is momentum on the exit of the trade? So you talked about momentum being a factor, talked about volume being a big factor on the momentum to get in. Then as you were talking about the deceleration of the momentum as the stock was rolling over, you mentioned you mentioned volume, but I'd like to know how important volume is on the exit side. Was volume high and then stopped? Does volume tail off? Because that's something that I pay a lot of attention to as well.
The volume remains high. The range expansion is there. So you're studying a 30-day period of what's the average daily range. Is it larger, right? And if it is, you know that there's a lot of activity in that equity. But again, just going back to the point, you can't dismiss the removal of momentum from an equity if you're going to prioritize it in the way in. That's something that's going to set you up. It's going to expose you to a significant decline. So with that being said, there might be, Kevin, a lot of times where I will take myself out of a position and the momentum didn't further fall the stock. So maybe the stock went sideways, didn't really go anywhere, but it didn't have that precipitous decline. So I kind of scratch my head and say, well, okay, yeah, that was a good move, but I didn't save myself a lot of money. That's perfect. That's what I want, because I'm never exposing myself, so to speak, to the knockout blow. I'm taking a little bit of a jab. So there might be 10 times that I'll utilize that strategy. And if 2 or 3 times it works effectively from shielding me from a very large loss, well, then I know it's the right strategy for me, even if the other, 7 or 8 times you really didn't see the follow through selling. If I didn't act upon that, and I had the one instance, and we'll use Peloton as an example, where the stock just didn't precipitously decline, it just basically fell off the cliff. If I would have sat in that, that's a very detrimental loss to take in a portfolio. And
Peloton, DocuSign, Netflix, PayPal. I mean, you mentioned 4 of them 5 minutes ago.
Yeah. And think about how long it takes a long-term investor to recover from those losses. I like to use the alphabet a lot. V-shaped, U-shaped, L-shaped. I'm always thinking, what can I put in my V-shaped basket? What can I put in my U-shaped basket? What can I put in my L-shaped basket? Because market recoveries after a decline either take the shape of a V, take the shape of a U, or take the shape of an L. And a lot of stocks you and I are talking about with that, ridiculous non-profitable valuation attached to it, well, there's going to be an L-shaped recovery.
And we saw it in 2020. I mean, we saw it in 2000.
Yes. And this is a 2000 moment for a certain subset of the equity market.
100%. I think it's always easy to take a small loss and recover from it. And that's what you're saying. It's almost impossible to come back because those stocks won't. They're down 60, 70, 80, 90%. They might come back a little bit, but they're not going to, if they stay in business, they're not going to go back to those all-time highs. And if they're lucky enough to do it, as we saw in 2000, it can take 18 years.
You're also emotionally injured from a larger loss. The emotional input comes back into play when you experience the larger loss.
And there's nothing preventing you from re-entering a position if it's reestablishing momentum. It's easy to get back in on a quarterly basis.
To your point, I mean, I never understood that, where people will always say, well, and on business television, a lot of times we'll get challenged on that. Well, why'd you get out? And I'm like, well, I can always get back in again. Unless we're hyper concerned about some form of a tax strategy, which most advisors can offset for their clients. But there's enough liquidity that you could always reestablish a position. And candidly, if there's not enough liquidity, you probably don't want to be there anyway.
Exactly. We have sold or been called away 6 times on Apple over the past decade. And we own it again now. It's not, there's no crime in going back and buying another stock. But the neat part is 4 of those 6 times we bought it back like substantially lower. Twice we paid higher. That's life. Sometimes it happens. But you never have to say you're sorry for taking a profit or taking a small loss. And I think that's the key to any rules-based strategy. And I love what's taking place in the JOET ETF.
How many holdings do you have in Devo?
25 to 30 is our sweet spot.
Perfect number.
Yeah. And that's Benjamin Graham. That's not me. I don't think of or invent anything. I just, like I talk to you, I find people that are smarter than me who, can teach me things. And Benjamin Graham made this strong argument that if you had more than 30 stocks, you're becoming more like an index than anything else, which isn't to say that 125, because guess what? It's your index, which is so cool. So
on a personal basis, I share your appreciation for Graham. And I personally utilize 29 as the number of individual stocks that I will never exceed that level based on his guidance. And then I just said, okay, well, I'm born on October 29th. 29 sounds like a cool number. It's one of the reasons it's above my shoulder. My daughter was also born on the 29th, so we share the number. And 29 is my number.
Well, if you're going to go that deep into 29, you got to tell us about 87 and 42.
All right. 87, my middle son is a huge Sidney Crosby fan.
Okay.
At 42, my eldest son, big baseball player. He wore that in honor of Jackie Robinson. So those 3 numbers represent my children. And we walked into Yankee Stadium years ago. We used to have season tickets before, teenage and high school life got in the way. And the kids loved the circular baseballs on the outfield wall at Yankee Stadium, all the retired numbers. And I said to the kids, okay, I'm going to retire your athletic numbers. I did that in my outer office, had those 3 numbers up. And then when we started broadcasting remotely for CNBC, they kind of gave me a little bit of a hard time about the blank white wall behind me. And, it was like, well, get a bookcase. And I said, well, everyone's got a bookcase. So I just went to the outer office. I pulled the 3 kids' numbers in, and it makes them kind of part of the show. And most people don't even realize it.
It's so cool because I'll tell you what I thought.
Mm-hmm.
You look at 87 and there's a stock market crash. You look at 29 and there's a stock market crash. So one day I was bored and I looked up 1942 performance of the equity markets. I know it's during World War II, and I'm thinking, I don't remember a crash in 42, but Joe's smarter than me, maybe. And of course there wasn't a stock market correction in 42. And I never thought to bother you with it or ask you, but I think that's a perfect way to wrap up an unbelievable segment. My attention span as a viewer of podcasts like 5 or 10 minutes, and this I could sit here and talk to you forever. I mean, so much fun, so awesome, and what a great story. Thank you so much, Joe, for coming on.
Kevin, thank you for having me, and let's do it again at some time in the future.
Absolutely.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through CWP Advisory Services. Investments are not guaranteed and involves risk of loss. The views and opinions expressed in this message are those of investment professionals made at the time this content was recorded, are not necessarily the views and opinions of CWP, and may change in time without notification. For additional information about CWP, visit CWP's or the SEC's website for a copy of our ADV disclosure brochure and Form CRS.